A lot of people go with supplemental plans. There's a lot of companies who offer the plans. And so I'm going to talk about really primarily the number one danger when choosing a supplemental plan. Welcome to Medicare School Daily, where we help you understand Medicare, save money, avoid making Medicare mistakes, and above all else, get the most out of your Medicare benefits. Now, when people begin to use their Medicare benefits and they enroll in Medicare, everyone has to, of course, enroll in Medicare A and B. And then beyond that, though, most people are going to get additional insurance. And when we get additional insurance, there's only two options available, and we cannot be on both of those at the same time. We have to decide which one. So some people will enroll in original Medicare A and B, and then enroll into what is called an Advantage plan. These are called C plans or replacement plans, which are basically a private health insurance company that's replacing original Medicare for you. And they will put together a network of providers, a series of co-pays that you're responsible for, and an annual max out of pocket, and usually some additional benefits as well. That's the Advantage plan. Other people will decide that they want to be in original Medicare A and B, where Medicare rules dictate, where Medicare pays first. But because Medicare doesn't pay 100% on things, there will be some remaining gaps or some financial liability, and most people don't want to assume that liability, so they will transfer that to an insurance company that in turn issues to them a supplemental policy, also called a Medigap policy, and they certainly have to pay a premium to that company for that company to take the risk. So we have Advantage plans and we have supplemental plans, so you have to choose what is best for you. But during this video today, I just want to talk about supplemental plans. A lot of people go with supplemental plans. There's a lot of companies who offer the plans, and so I want to talk about really primarily the number one danger when choosing a supplemental plan. Again, there's 10 different plans, and most people today either buy an F plan or a G plan or an N plan. But regardless of the carrier we go with or the plan that we select, there is a certain danger that you must understand. All right, so we're going to talk about basically initial rates and rate increases. So let's talk first off about initial rates. Now, it is the insurance commissioner in your state that really decides how an insurance carrier is going to provide ratings. And there's actually three different rating systems available. I'm going to explain those to you. Most states allow just one. Some states will allow two. I don't know of any state that allows three. And so it's the state insurance commission that dictates how that insurance company is going to establish those initial rates. All right. So first possibility is what's called a community rated plan. Now, a community rated plan has nothing to do with age, has nothing to do with gender or tobacco status. It has everything to do just with where you live, a geographical area, because everybody in that geographical area that's buying a supplemental plan, whatever one they're buying, will have the same rate. Which means what? Younger people pay a little bit more, people that are older pay a little bit less, but everybody is going to pay the same rate. That's a community rated plan. The only thing that matters is geographical area. Now, the second way, and actually the most common way that insurance companies are rated, because the insurance commissioners dictate this, is what is called an Attained Age policy. Now, Attained Age policies, when you initially come into that, will be based upon your age, which means a 65-year-old person pays less than a 68-year-old person. It'll also be based upon your gender, whether female or male. Normally, female rates are a little lower than male rates. And then also tobacco status. Some states allow the carrier to ask whether you have had tobacco products in the last 12 months. If the state allows that and you say yes, you're going to pay about another $10 more than what a non-tobacco person would be. But the point is this: Attained Age rates based upon age, gender, and possibly tobacco status. And that establishes your initial rate. Now, the initial rate is going to be substantially lower than a community rate. All right? Now, what happens with the Attained Age policies is the insurance carrier has the right to raise your rate a little bit every year. So at 65, I may pay $100. At 66, I may pay $103 or $104. At 67, I may pay $111. But they have the right to raise that rate up every year just a little bit and basically just offset medical inflation. Now, Attained Age policies can also go up if the whole group goes up. So community is only group going up, but Attained Age, we're going to see a slight increase every year, and then the potential of group increase. Now, the philosophy behind Attained Age is by allowing the carrier to raise the rate a little bit every year, those group increases will be less frequently and less frequent and less drastic. All right, so that's the theory behind that. The third option we have is to do what's called an issue age policy. Now, issue age in most states is based upon just the age you are when the policy is issued and whether you're a male or female rates. All right, so these are going to be a little higher than attained age because with these, the only way those rates can go up would be if the whole group goes up. All right. And so all rates are going to go up with all these different policies, but depending upon the rating methodology will determine how the premiums can increase. All right. So let's talk about that next. So rate increases on community. The only way it can happen is if the whole group goes up. It has nothing to do with age, has nothing to do with gender, has nothing to do with tobacco status. It's only if that company begins to lose money, then the whole group is going to go up. When it comes to attained age, as I said earlier, you're going to see a slight increase every year. It's a real minimal amount, $3 or $4 a month, something like that, but it's going to go up. And then the group can also occur. But remember, the philosophy is if they allow the carrier to raise a little bit every year, we should see less of these and certainly less drastic increases. And then the third way was issue. Initial rate a little higher, but now the only way the issue age policies can go up is if the whole group goes up. So as you can see, everyone is going to go up and everyone can have group increases. This is the only one that can go up a little bit because of age. Now, people ask me all the time, Marvin, what's the best? There is no best, okay, at all. The state insurance commissioners already determined what is available in your state, but there is some way to kind of mitigate the risk of these group increases, okay? And so that's what I want to explain next. So here's the way group increases occur. Remember, everyone who buys a supplemental plan is going to go into a group. So what's happening in the group is the premiums from the policyholders are being paid into the group. So we got money going in. Typically, people pay through monthly bank drafts, so we got lots of money going into the group. And when you pay that premium, what are you doing? Well, you're transferring the liability of some of the Medicare gaps to that insurance company. That's why you pay them a premium to take that. So therefore, they have to pay money out. They're paying money out in claims. They're paying hospital bills and doctor bills and MRIs and CAT scans and surgery. They're paying money out. So money goes in the group. Money goes out. Now, what will happen eventually with all the groups, whether it's a community group, an issue age group, or an attained age group, eventually more money will go out in claims than's coming in through premiums, which means what? When more goes out than's coming in, that insurance company is losing money. They're protected by law. They don't have to lose money. So what they do whenever they're losing money, they will calculate the loss. And let's say in this example, they're losing 5%. Premiums are no longer covering all the claims. 95% of them are covered, but we have 5% loss. So what happens is they take this 5% loss number and they have to go to the insurance commissioner to be able to get an increase to cover that. And so the insurance commissioner will receive the paperwork from the insurance company. They will audit that paperwork to see if indeed that increase is truly justifiable. And let's say that it is. And so the insurance company gets back and says, an insurance company, you can now raise everybody in the group 5%. So they are protecting the consumer. And if they approve it, everybody has to go up. No one will be singled out because they've had lots of claims. They won't be singled out because of their age. They won't be singled out for any reason other than they're in that group, and everyone goes up the same amount. All right. And so that group increase can happen whether it's community, whether it's attained age, or whether it's an issue age policy. We're going to see rates go up. So back to our question. I'll close with this. The number one danger when choosing a Medicare supplemental plan is rate instability. Yes, I care about the initial rate, but it's not the most important thing. What I really care about, what will those rates look like in 3 years or 5 years or 10 years down the road? Well, the truth is I don't know what they're going to look like because there's two things that determine rate stability, and that is the size of the group and the health of the group, all right? And so I don't know the health of any group. We don't know how much cancer or knee replacements or hip replacements are going to occur in the group. I don't know anything about that. But what I can find out is the size of the group. And that's why we as a company like national carriers, because they typically are larger. And so what happens, more policy holders, what it'll do as the premium comes in, more policy holders are going to offset the risk of some of the unhealthy people that are in the group. So the bigger the group, typically we're going to have more premium stability. And so that's what we look at, because we can look at the history of these companies, the last 5, 10, 15 years. How stable have they been? How often have they raised rates? How drastically have they raised rates? And there are some carriers that frankly raise their rates more frequently and more drastically. Typically, that's because they have a smaller group. So we like to go with large groups because usually they're going to provide a greater stability for you. So yes, I care about initial premium, but I also equally care about the rate stability because you're going to be on this for life. And so we want to make sure we're going with a carrier that is proven to be rate stable. Hey, thanks so much for watching the video, and I do hope that it was helpful. Now, if you feel like you need to learn more about Medicare to make sure you're making the right Medicare decision, really the best way and the easiest way to do that is to go to MedicareSchool.com. That's MedicareSchool.com, and you'll be given the opportunity to click on Get the Free Workshop. We call that the Essentials Workshop, and I do all the teaching, and there you'll learn all the ins and outs of Medicare to make sure that you have an accurate and thorough understanding of how Medicare works. The second thing you can do is click where it says Talk to a Medicare Guide, and there you can actually set up a time where you can discuss your situation with the Medicare Guide. They'll explain all your options, and they'll actually even walk you through the enrollment process as well if that's what you need to do. And so go to MedicareSchool.com, watch the workshop, or talk to a Medicare Guide. It would be our privilege to assist you further.